Over $1 trillion. That is how much money global companies now invest annually in sustainability initiatives. And here is the part that will stop you in your tracks: the businesses leading the charge are not doing it to save the planet. They are doing it because it is making them extraordinarily rich. Welcome to Trend Now Daily. In the next 10 minutes, you are going to discover exactly how sustainability went from a fringe environmental concept to one of the most powerful profit-generating strategies in modern business history. You will find out which companies saw this shift coming decades before anyone else, why the old idea that green business means less profit has been completely demolished, and the one counterintuitive truth that most corporate consultants will never admit out loud: sustainability did not slow capitalism down. It turbocharged it. To understand where we are today, you have to go back to the 1970s. The environmental movement was loud, passionate, and almost entirely disconnected from the business world. Companies viewed environmental regulation as a threat. Something to resist, lobby against, and work around wherever possible. The dominant economic theory of the time, championed by Nobel Prize-winning economist Milton Friedman, said it plainly: the sole responsibility of a business is to increase its profits. Environmental responsibility was seen as a cost. A drag on the bottom line. A charity exercise that shareholders would never tolerate. Then something unexpected happened. In 1987, the United Nations released a landmark report called Our Common Future, authored by the Brundtland Commission. This report gave the world a definition of sustainable development that would quietly change everything. It described sustainability as meeting the needs of the present without compromising the ability of future generations to meet their own needs. It was a philosophical statement. But inside boardrooms, a small number of forward-thinking executives began to hear something else entirely. They heard opportunity. Through the 1990s, a few early movers started experimenting. Interface, a carpet manufacturer led by Ray Anderson, became one of the most talked about case studies in business school history. Anderson had what he called a spear in the chest moment in 1994 when he read a book about environmental destruction. He made a radical decision to transform his industrial company into a model of sustainability. What happened next surprised even his harshest critics. By cutting waste, redesigning production processes, and rethinking raw material sourcing, Interface saved over $400 million in costs within a decade. Sustainability had not hurt the business. It had funded its own revolution. But Interface was not alone. Around the same time, companies like Patagonia were building entire brand identities around environmental responsibility. Patagonia famously ran a full-page ad in the New York Times that said, "Do not buy this jacket," urging customers to think before purchasing. It sounds like commercial suicide. Instead, sales surged. Consumers responded to authenticity in a way that traditional advertising had never achieved. The psychology was simple but profound: when people trust a brand's values, they become loyal in a way that no discount or promotion can manufacture. By the early 2000s, the business case for sustainability was gaining serious academic and institutional backing. Harvard Business School professors began publishing research showing that companies with strong environmental and social practices consistently outperformed their peers over long time horizons. The data was not subtle. Studies covering thousands of companies across multiple decades showed that high sustainability firms generated significantly higher stock market returns than low sustainability firms. The old Friedman model was cracking. But here is what nobody talks about. The real turning point was not environmental awareness. It was risk management. Corporate risk officers started running that numbers and realized that climate change, resource scarcity, and regulatory tightening were not distant problems. They were near-term financial threats. A drought in one region could collapse an entire supply chain. Rising energy costs could wipe out profit margins. New emissions regulations could make entire product lines obsolete overnight. Sustainability stopped being about values. It became about survival. This is where the story gets genuinely fascinating. Because once the risk management argument clicked, investment capital started moving in ways that permanently altered the landscape. In 2004, the United Nations Global Compact published a report with a phrase that became one of the most cited lines in finance: environmental, social, and governance factors are material to investment performance. That phrase launched what we now call ESG investing. And the numbers attached to ESG are staggering. By 2022, global ESG assets under management had surpassed $40 trillion. Let that land for a moment. $40 trillion tied to investments screened for sustainability performance. That is not a niche. That is a fundamental restructuring of how capital flows through the global economy. Companies quickly realized that poor sustainability performance was not just a public relations problem. It was a direct cost of capital problem. Businesses with weak environmental records were starting to pay higher interest rates on loans, face more expensive insurance, and watch institutional investors quietly divest from their stock. The financial incentives had completely flipped. Being unsustainable was now expensive. Being sustainable was now cheap, and getting cheaper every year. The technology revolution accelerated everything. Solar energy costs dropped by 90% between 2010 and 2020. Wind energy followed a nearly identical curve. Suddenly, the renewable energy transition was not a sacrifice. It was a straight-line cost reduction for any business willing to make the switch. Apple committed to running all of its global facilities on 100% renewable energy and achieved that goal in 2018. The motivation was partly reputational, but primarily economic. Long-term energy contracts with renewable providers gave Apple price stability that fossil fuel markets could never guarantee. Amazon, Microsoft, and Google followed with their own aggressive sustainability commitments. And here is where the competitive dynamic becomes truly interesting. These pledges were not just about operational efficiency. They were talent recruitment weapons. Research consistently shows that younger workers, particularly millennials and Generation Z, actively choose employers based on environmental and social values. In a labor market where attracting top technical talent determines competitive advantage, sustainability commitments became a human capital strategy. Companies that ignored this dynamic faced measurable disadvantages in hiring. Consumer behavior also transformed in ways that permanently rewired product strategy. Nielsen research found that 66% of global consumers said they would pay more for sustainable products. Among millennials, that figure climbed to 73%. Brands from Unilever to Nike to IKEA responded by embedding sustainability into their product development cycles, not as an afterthought, but as a core design principle. Unilever reported that its sustainable living brands grew 69% faster than the rest of its business in 2018. That is not a rounding error. That is a market signal of historic proportions. Regulatory pressure then locked in what market forces had started. The European Union launched its Green Deal, committing to making Europe the first climate-neutral continent by 2050. The SEC in the United States began developing mandatory climate disclosure rules for publicly traded companies. Carbon pricing mechanisms spread across dozens of national economies. The message from governments worldwide was unmistakable: the cost of environmental damage would no longer be externalized onto society for free. Businesses would pay for it. Which meant businesses that reduced their environmental footprint first would gain a structural cost advantage over competitors who waited. The strategic logic had now reached its full form. Early adopters of sustainability practices were seeing advantages in energy costs, supply chain resilience, regulatory compliance costs, access to capital, brand equity, customer loyalty, and talent acquisition simultaneously. Sustainability had not become one business strategy among many. It had become the meta strategy that touched every other part of the business. Companies that failed to grasp this were not being idealistic. They were being strategically blind. Today the conversation has evolved again. The concept of stakeholder capitalism, popularized by the World Economic Forum's Business Roundtable statement in 2019, explicitly rejected the idea that corporations exist solely to serve shareholders. 181 of America's most powerful CEOs signed a statement declaring that businesses must deliver value to customers, employees, suppliers, communities, and shareholders equally. Whether or not every signatory has lived up to those words is a fair debate. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Trend Now Daily for a brand new video every single day. We will see you in the next one.